What's up, guys? My name is Matt Faircloth, and we're going to talk today about bank runs and how it will affect real estate investing. Before we get there, again, my name is Matt. My company is called the Derosa Group, and we're a real estate company dedicated to transforming lives through real estate. And because we're a real estate company, we're obviously paying attention to what's going on in the world. We hadn't heard about these banks in the United States that are just closing down overnight. And the reason they're closing down or going bankrupt, having major financial difficulty, let's say, to keep it bottom line, is because of a concept called a bank run.
Something funny going on over there at the bank.
Now, what a bank run is, the people that have their money on deposit in the bank all go and say, hey, I want my money out. I'm going to go take my money and put it somewhere else.
Hey, you got any money in the bank? You better hurry.
Now, you might think that if if this is $1 and I give that dollar to my bank, they just sit there and hold it and wait for me to come back and say, hey, could I have that dollar back? You would think logically that's how it works, but no, that's not how it works. Banks take money. When you put money on deposit with them, they take money and they put it to work in other things. They may invest it, as SVB did and as other banks did, invested in things that maybe didn't work out. Maybe they made some bad decisions about those investments. This video is not about discussing SVB or decisions that they made on their investments, by the way. Or they likely do what a lot of banks do, is they take that dollar and they go and loan it out. And they can even loan out multiples of that dollar to other people, meaning they might get approval to cut 5 loans just because they have this $1 on deposit. So that's how banks make money, is they take your deposits and they go and put it to work through loans and make a spread on their, pay you this much interest on your dollar, but they make this much interest from the world, right? So long story short, this dollar is at work when you give it to the bank. And so if a lot of people go and run on the bank and go and say, hey, I want my dollar back, want my dollar back, want my dollar back, the bank very quickly runs out of its deposit reserves that it needs to keep this side of the business going, all its loans and its investments and all the other stuff that it does, right? In a nutshell, that's what a bank run is. And that's what happened with SVB, that a lot of people on social media heard that SVB was having financial difficulties. And then boom, like within 24 hours, the bank, went under because a lot of people heard about it and went and took their money out. And now they're in the situation they're in, right? So the question is, does a run on banks, or the potential thereof, because some would say that maybe we haven't seen the end of this. Maybe the few banks that have gone under, for whatever reason it is, maybe there's more banks that are going to go under, which is the point of this video on how it's going to affect our industry, because my company's been investing in real estate for the last 17 years. And so what's my opinion, and that's all it is my opinion, on how a bank run would affect real estate investing. So the first thing that people wonder is their cash, right? So my company, of course, has cash that we use for properties that we own. We own primarily apartment buildings. Am I going to lose that cash? Or are you somebody that owns a duplex or a 10 unit or a 300 unit or whatever you got? Is your cash at risk? The short answer to that is maybe, but likely no. What I mean by maybe, but likely no, is that if you deposit less than the FDIC insured limit, which are likely going to increase this, but it's currently $250K. So if you have $250K or less in that checking account, then you're okay. You're covered. You're insured by the FDIC. Now, in the case of SVB, the FDIC came in and insured over that amount. Just because they're nice guys. No, they don't want there to be panic in the system for people saying, oh my God, they wouldn't insure over $250K. I've got to take all my money out or whatever. So they insured well over that because they want to see continued confidence in the United States banking system. Probably something we should maintain, right? So they insured over that number. And my speculation is that if there were a bank run, as long as not like 150 banks get run on all at once, that's kind of doomsday scenario, right? But as long as doomsday doesn't happen, the government will, I believe, will continue to insure up to the entire deposit amount that the bank is supposed to have on deposit that happened before the bank run, right? So that's my belief. If you really want to be conservative, then keep all your accounts less than 250K, which isn't that hard to do because 250K is still a lot of money, right? The other thing you need to be concerned about is your security deposits for your rental properties. Security deposits are things that a tenant gives you. It's their money, is still their money, holding it on their behalf. And then when they move out, you give it back to them. If they don't do any damage to the property, don't owe you any rent when they move out of the property, then you have to return that money to them. You kind of hold it as collateral, as like just in case. But that's their money, right? Last thing you want to have happen is if a bank run happen and have tenant security deposits become at risk for that. So you want to make sure that your security deposit accounts are also insured by FDIC or other insurance programs, which you can get on bank deposits. That is the concern with cash. And primarily, I don't think you have a concern But again, Matt's opinion, but over 250K, I still don't think you have a problem. So that's my opinion on cash deposits, either security deposits or your banking deposits. So the next thing you might ask is, well, Matt, what about my loan? What if like a major bank, like, I don't know, Bank of America, Wells Fargo has a run? But if there were, or if we're even a small community bank in your local community that holds a mortgage on your property that you own, here's the thing there, right? Mortgages on property, it's a liability for us, right? You think about assets and liabilities, your balance sheet, right? The things you own, your assets, your real estate, your cash, and the debts you have, your liabilities, right? Well, that's actually turned the other way around to a bank. A bank views the loan that you have on your duplex, triplex, 300 unit apartment building, all that is viewed as an asset to the bank. So even if the bank has a run on the bank, what the run to a bank is a drawdown of liabilities that they have, and they don't have that money sitting there to pay back the liability to you, the depositor, right? But they still got the asset. They still got the mortgage on your property, and you still have to pay them a monthly, payment on it. Think about it. That's a revenue stream for them, right? It's a revenue out the door, an expense line for us, but it's a revenue stream to a bank. So here's what happens for mortgages that the banks own if there's a bank run. Like SVB and Signature are both being bought by other banks, right? The first thing that bank is doing is they're buying it and they're picking up those assets. So they're going to get those mortgages and they're going to inherit them, and they're going to keep getting the monthly payment that you were paying SVB. They're going to take those loan payments, and now XYZ Bank now gets those loan payments. Pretty plain and simple, right? So if you have a mortgage with a bank that does have a bank run and goes under, all that's going to happen is you're going to get a letter or a phone call that says, hey, you were writing your letter to XYZ, so sorry for them bank. Now you're going to write your letter to AB. You're going to write your mortgage to ABC Bank, who inherited that loan and is now servicing the debt, and yada, yada, yada. Even if it's a workout bank or whatever it is, your debt is not at risk. And that's because your debt is defined and protected through the mortgage documents that you signed when you bought the property, right? So whoever buys that bank and that asset, that mortgage, has to abide by the terms of the mortgage. They can't say, hey, Joe Smith, the interest rates have gone up, and I know this mortgage says you're supposed to pay 4.5%, but forget that. We're going to charge you 9%. They can't do that. The confines of your mortgage agreement state how much they can charge you, right? You might want to read that to make sure that you're not on a floating rate mortgage or whatever it is. But even if you are on a floating rate mortgage, it's going to define floating as to what indicator and how much it can float above. So even your interest rate is going to be protected as well, even if it's floating rate, fixed rate, whatever, in your mortgage documents. So that is not at risk. The one thing that's at risk with regards to loans, if the bank that you have a loan with had a bank run, would be a line of credit. So if you got a home equity line of credit on your home, I do, and I use it to lend out hard money. That's what I do with my home equity line of credit. You should do that too. We also have business lines of credit for our company that we use for deposits on new properties or for major renovations we're looking to do. Whatever it is we're doing, that's what the business line of credit is there to do. The way a line of credit works is the bank approves you for a line, says, okay, you can borrow up to X amount of dollars, put it on the shelf and say, in case of emergency, break glass. You want to use it for day-to-day operations of your business. Home equity lines of credit, business lines of credit, whatever those things are, you should certainly look into them because they're great to use if you have an emergency. And also if you just want to do some expansion expenses in your company or use it for earnest money deposits, whatever. If you have a line of credit, there is a bank run. Your bank is going to go after that line of credit immediately. What they're going to do is they're going to convert that line of credit to a loan if you have anything drawn down on it. So let's say you got a line of credit for $100,000. You spend 20 and there's a run on the bank and they put the brakes on and reel everything back in. They're going to say, okay, you now owe us 20K and we're going to stop any further borrowing on that line of credit. So they're going to freeze the line. That's what that's called. And then they're going to make you come up with a payback plan to spend that 20K back to them, right? So lines of credit are at major risk if your bank has a bank run. And so I recommend that if you're going to use line of credit, don't use it for long-term expenses. Use it for get in, get out, for 30-day, 45-day expenses with a clear plan on how you're going to get it back. I've been in situations where I use lines of credit, so I wasn't sure how I was going to get it back. I ended up owing that line of credit for a long period of time. longer than I wanted. So side note, if you have a line of credit at all at a bank, make sure that there is a clear path for you to get the money off that line and over to a refinance or to a sale or whatever, if you're concerned about bank runs at the bank that you're at, or even it's just good business practice to not let a line of credit ride for that long because the rate floats, goes up and down. So I use my line of credit on my home for hard money loans. As I said, there's a revenue stream that comes in that I'm making a monthly payment for the hard money loan that I have. And so I'm covered there. And even if the rate goes up and up, or if the line gets frozen, whatever it is, I've got a revenue stream that is paying the interest rate on that line of credit. And when the home hard money loan that I have gets paid back, it pays the line off. Make sure it's something like that if you're concerned about bank runs. So those are all the things you need to be thinking about with regards to direct effects of your business through a run on the bank. Now, about all those things about like, is my cash going to go away? Is my, my bank loan going to change or whatever? Worry about that. Think about that. Make sure you're protected, but it shouldn't take too long for you to protect yourself. Here's what you really need to be worried about. That is the indirect effects of bank runs, right? What is a bank run? As I said before, it's a bunch of people going to take their money out of the bank. Why are they doing that? They're doing that because they're worried that the bank's not going to be stable anymore. And if they're worried that bank's not going to be stable, then they're also worried that the economy is not going to be stable. So there is a level of consumer confidence you need to be concerned with about bank runs. If you're raising capital from investors, those investors and those that are working with you financially are going to become more and more concerned and skittish with regards to business in the world and the economy and whatnot. If there are more bank runs, it's going to make people less confident in the financial world, whatever that may mean to you. It's going to become just more squirrely, more gray of what the future is going to look like with regards to making new commitments to anything, right? To investing with you, to working with you, partnering with you, selling a property to you, buying a property from you, whatever that may look like. It's going to make the world a little more skittish, right? So indirect effect, but be wary of that, right? Second thing is, if you have tenants, all landlords do, right? All landlords of folks in the real estate business likely have some sort of a tenant that are paying them revenue. Tenants will have financial issues, either if they're individuals getting laid off from their jobs, unfortunately, having to find a new job, or if they work at one of these banks that has a bank run. So you should definitely be concerned about your tenants' financial well-being if they get removed from their jobs. If a lot of your tenants are working in some sort of banking industry or in a subset or a derivative of the banking industry, be concerned about your tenants losing their jobs and your tenants' economic stability becoming less because of the world changing, because of economic blowback, stock market crashes, whatever. That's really what you ought to be thinking about. And of course, these things are outside of your control, but you should still be thinking about things like that. So the bottom line, guys, the big thing that a bank run should concern you as a real estate investor on is consumer confidence. All consumer confidence, as I said, buyers, sellers, investors, anybody you interact with, and you yourself, about where the world's going. If there are more bank runs, understand what that is. Like I said, it's people pulling their money out of a bank because they're concerned that that bank is no longer safe. If that's what people do more of, then you should be thinking about the global, where we are emotionally as a country, what we're worried about, what we're not worried about for those things to happen. Not going to affect your day-to-day business as much as you think that it might. Again, these are Matt's opinions, my 2 cents on this thing. So that's what I got, guys. Appreciate you. If you guys want to hear more about what we have to offer, both in the education and the investment side, you can check us out at derosagroup.com. I appreciate you guys watching. Leave a comment below. Tell me how wrong I am. It's cool. I love it. Tell me how wrong I am. Tell me how right I am. Like this video, share this video, do all that, subscribe to this channel. I appreciate you as always. Thanks for watching, guys. Have a great and profitable week. Hey guys, if you like this video, here's a few more you might like too. Thanks again for watching. Make sure you subscribe and like this video.